Ray Dalio's success is the type of story that drives the American dream. As a child, he and his family lived in a middle-class neighborhood on Long Island. He started working as soon as he could, collecting tips as a golf caddy when he was just 12 years old. Even then, he had an eye on the stock market, and he collected stock tips from his golfer clients along with the cash. Dalio started investing that year, and by 1975, he was ready to enter the big leagues. He launched Bridgewater Associates from his two-bedroom apartment, and in the 40 years that followed, he grew his company to be the largest hedge fund firm in the world. Today, Bridgewater Associates manages $160 billion in assets, and Dalio has an estimated net worth of approximately $18.7 billion. Dalio credits much of his success to a unique method of portfolio construction, one he developed after some painful lessons about diversification during his early years of investing. We will analyze how this method of portfolio construction works during the next minutes. In his book Principles, released in 2017, he sums up the concept this way. With 15 to 20 good, uncorrelated return streams, you can dramatically reduce your risks without reducing your expected returns. Let's see how this method of portfolio construction works. A key item is to understand what the marginal benefits of diversification would look like. What we need to think about is: first, the risk, measured by the annual portfolio standard deviation. Second, the number of assets, alphas in the portfolio. And third, the correlation of the betas, broke it down into each of its components. Let's look at an example. Let's assume you have a return that has a 10% risk, measured by the standard deviation. And to make it simple, let's say it has a 10% return. Let's add in another asset, another return stream, then we add in a second, a third, a fourth, a fifth, up to whatever number we want to. How would that reduce my risk? If on average, it has a 60% correlation, or if it has on average a 40% correlation, or a 0% correlation, how would that change? So that's what this chart shows. So you have that 10% average return, with 10% risk, and you add in a second and a third stream and so on. You're not going to lose that 10% return, as you add new streams, but you're going to then have a reduction in risk. If it has a 60% correlation, you will get a reduction that maybe is about 15%, but with a correlation of 60%, you could add in 1,000 more streams, and you're not going to reduce your risk much more. That's why correlation is key here. This changes according to the level of the correlation. If something has a 10% correlation, at about a sample size of 7 or 8, we cut our risk in half. That means that we double our return relative to our risk. That's really good. When we go down this, we start to understand what the power of diversification is, in terms of the assets we are going to look for. You only need to do this simple thing, to find 15 or 20 good, uncorrelated return streams. These are assets that are probably gonna make money, but you don't know for sure if that will happen, but they have a good probability of making money. But you have that they are uncorrelated, or that they have low correlation. That's the key here. A lot of people think that the most important thing you could do is to find the best investments. Okay, that's important, but there is no a great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, by 5 times the expected return for that unit of risk. You can't pick any investments like this. Probably nobody is humanly capable, in an efficient market, to pick investments that are 5 times as good individually. So this shows us the power of diversification, and of balancing risk. This is the return to risk ratio, that happens for each one of those. If I can get a 0 correlation, and I have 15 to 20 assets, I'll have a return to risk ratio of 1.25. That means that my probability of losing money in a year is only 11%, down from 40% with any one of this individual assets. I hope you enjoyed this video, and please subscribe to our channel. If you leave some comments and push the like button, so our video can be shared with more people, that would be much appreciated. Thanks, and I see you in our next video.